Are you a married taxpayer? Would you like to learn how to save money in your taxes? Do you have medical expenses? Do you have childcare expenses? Well, if you meet this criteria and you'd like to learn how to save money on medical expenses and childcare expenses, then this video is for you. One of the advantages of being a married taxpayer is the ability to hire your spouse. You see, when you do this, when you hire your spouse, you have the ability to establish benefits not available to single taxpayers. I think this is just awesome. If you're a married person with 2 children or even no children, you have no employees or you have employees, you could establish these benefits, and then your wife takes the benefit on behalf of your family and you just pay her like any other employee. Now, one such benefit I would like to talk about is the Qualified Small Employer Health Reimbursement Arrangement. It's called QSARA for short. This was signed by Obama in December 2016. You see, QSARA allows for reimbursement of medical expenses and premiums of up to $5,050 for singles and $10,250 a year for families. Now, no other plan does this. Now, with other plans, even with the health deduction or the S Corp, health insurance, you can only deduct your premiums. This is the only plan that allows you to deduct premium and medical expenses. Remember, the only other way you can deduct medical expenses is by itemizing. But now in 2008, with a higher standard deduction, most people are not even going to qualify to itemize in the first place. And not only that, itemized deduction is subject to 7.5% of your adjusted gross income in 2018, which means even if you do qualify, 7.5% of your AGI is not even deductible. I mean, this is a win-win. This is such a great way to get deduction for your health insurance premiums and expenses, which you have to pay anyway. It's not like you don't even have to spend the money. But now you spend the money and you also get a tax benefit as a result. So next we'll see how this plays out. I would like you to meet Joe and Sarah. Joe is a small business owner, works very hard. At the end of the year, he nets $50,000 for his business, which means he has a tax liability of $4,731 for the year as a married filing jointly taxpayer. Now, his wife, Sarah, currently does not work. They have 2 children, but during the day, Sarah's kids go to school, so she's like, I have nothing to do. I'm bored out of my mind. And then Joe says, come on, come work. I have some work. You can do some bookkeeping for me, some paperwork. I have tons of things you can do. So she starts working for Joe. Joe pays Sarah $10,000, gives her a benefit of $10,250 for the QSARA. So this brings Joe's income down to $39,750. Now look at what happened to his tax liability. Rather than paying the $4,731, he gets a refund of $886. That's a $5,617 tax saving. You can see how huge this is. This is really big. I mean, the net amount coming into his home has not changed. The way it comes in has changed. Now, part of it now comes through Sarah, who brings it back to the home. He's already paying medical expenses. So why not get the most tax advantage he can get? I mean, I think this is just a huge tax savings. Now, take into account, just so you know, this example does not take into account the effect of payroll taxes, but even with that, I mean, you still come out way ahead. Let us talk about childcare expenses. When you have children, you probably have to take them to daycare or after-school programs. You probably have heard by now that the tax code does allow you a credit for paying for childcare. However, this credit is 0 when your spouse does not work. If you have a non-working spouse who often has to get childcare because they have to help you in the business, for example, in the example above, Joe and Sarah, let's say Joe gets really busy in his business and Sarah now has to start working even when it's time to pick up the kids. And so because of that, they have to do after-school care. Paying her to work in your business also helps you, because if she's not working, if she's not getting paid, then she can't even take this credit. Also, if you have a spouse that works somewhere else, it might be better off for him or her to work for you in your business, because what happens is that income he or she gets from somewhere else will put you above threshold. Meanwhile, they work for you, you'll still be below the threshold to get certain credits. So let's take a look at an example. So looking at Joe still making $50,000 on self-employed income. The only difference here is here he paid his spouse and here he did not pay his spouse. Now, I'm removing all other considerations. The only thing I'm comparing is the difference based on the difference between the credit he can claim if he spent $3,500 on daycare. So here he spent $3,500 on daycare, and he wasn't able to get the credit. But here he was able to get it because he paid his spouse $10,000. So that's a difference of $597.41. It might not seem big, but those little differences do add up. I mean, $600, I mean, for a family that makes $50,000, maybe that's a trip they can take with their family. So these little differences do add up when you really sit down and think and do some tax planning. If you're interested in this Excel file, you can download it by clicking the link below. But in the meantime, just let me know what you'd like me to talk about next. Just leave your comment down if there's any issue that's bothering you that you'd like to see me make a video on. Go ahead and leave a comment for me. Also, if you like the content, be sure to subscribe so you get an alert when a new video is posted. And if there's any general comment you have, how I can improve things, go ahead and leave a comment. I look forward to reading your comments. Thank you.